And today we're going to be talking about Ethereum and smart contracts. Philip's going to be talking about the protocol, kind of laying out the differences, and then I'm going to be talking about use cases of Ethereum and try to help you build a framework on how you can think about what blockchain apps are good for distributed tech in general. So I think you'll find this lecture pretty useful. All right.
Yeah, so we're going to begin by talking about Ethereum, which is from their marketing splash page. They market themselves as a blockchain app platform. And, if you read about Ethereum, you'll see a bunch of these like buzzwords: blockchain, trustless, decentralized apps, Bitcoin 2.0. And but what does it all really mean? What is Ethereum in actuality? So let's kind of break it down. There are a couple of different ways to view Ethereum. First, it's a decentralized platform that can execute smart contracts. And I'll kind of go into smart contracts later, but what you can think of smart contracts right now is basically you have this network of every node, and on every node they have a copy of the entire state of every contract, every person on the network, all the accounts, and they all execute in lockstep, essentially, updating the smart contracts at the same time. And in that way, you can have code that executes across like a worldwide network that you can trust. Everyone else agrees that has the same output, basically. And so the second point is Ethereum is an account-based blockchain, which is a bit different than Bitcoin. Bitcoin is a UTXO-based blockchain. What I mean by like account-based or UTXO-based, what I mean is the state of the network is essentially made up of either accounts in Ethereum's case or UTXOs in Bitcoin's case. And I'll kind of go into that in more detail in a second as well. Another way to think about it is Ethereum is like a distributed state machine. So every time you get a block, you move from your previous state to the new state. And the block is like the state transition function that updates all of the smart contracts, all of the account values, and etc. Let's see. So I guess going into a little bit more detail, again, they're both Bitcoin and Ethereum are both marketed a bit differently, even though they share many of the same features. So, for example, Ethereum is a smart contract platform, and Bitcoin is more marketed as a decentralized asset. And while Ethereum has a decentralized asset and Bitcoin has scripting capability, they both have they're more specialized in their particular use case. And some different like miscellaneous implementation details. Ethereum uses a 12-second block time. And the reason why they use a very quick block time is so that the smart contracts can be updated quickly, whereas Bitcoin uses a 10-minute block time, which is considered more secure. The exchange rate of Ethereum is about like $12.50 versus Bitcoin is like $635. And ETH hash, which is the Ethereum proof of work, is actually ASIC resistant, which is interesting. So let's go into what accounts mean in Ethereum. So, if you look at Bitcoin, how do you know how much money you have? Basically, the amount of money you have in the Bitcoin network is defined by the set of private keys of addresses whose transactions whose outputs are pointing to those addresses are not yet spent. In other words, the UTXOs. So if you see Bob, he owns a bunch of private keys to some UTXOs, and therefore he has 10 Bitcoin. Whereas in Ethereum, they use kind of, in some sense, more natural model. It's called accounts. Basically, every user or actually every entity on the blockchain is an account, which has a balance, an address, and optionally some code. And so what that means is that instead of having to compute your balance like dynamically by like going over each of your UTXOs, the balance is actually updated as part of the blockchain state transition. And specifically, there are two different kinds of accounts. There are externally owned accounts, which are like user accounts, which don't have any code associated with them. And then there are contract accounts, which do have code. And it's interesting to know that both contracts and user accounts have, addresses, ether balance, and they're in some ways the same thing, except they make this kind of arbitrary distinction, I guess. So what's interesting to note is, I kind of mentioned this before, but the state of the network, what every node in the Ethereum network agrees upon, is the state of every account. And this is compared to Bitcoin, where every node of the network agrees on the current state of all the UTXOs. And what that means is that in the Ethereum network, every node has to keep track of every account, its code, also its storage, because each contract can have some amount of permanent storage. They have to keep track of all the balances, all the addresses. So it's definitely a more hefty kind of blockchain than Bitcoin in that sense. But there are some important rationale. Most importantly, when you're programming smart contracts, it's definitely more natural, more intuitive to think about sending money from one account to another account, or sending money to like a contract instead of sending money to a address. I guess you send to an address, but when you're trying to compute like a balance, instead of having to dynamically keep track of UTXO sets and like summing over them, you can just look at the balance variable more or less. I'm kind of going to skip this replay attack because it's kind of an implementation detail, but it's interesting. So what is a smart contract? If you think of like a regular contract, it's like kind of an agreement that people write down or something. You have your lawyers write down an agreement between two parties that might not necessarily trust each other, so they can arbitrate at a later date if one of them goes out of line. In the case of a smart contract, you kind of put all that arbitration logic that would be gone over in a court into a contract, a digital contract that has code. So the code basically does the arbitration. And what's interesting in the case of Ethereum is that this code is run on every single network. So every node on the network agrees on what the outcome of each contract is at any point in time. And so one interesting analogy is that contracts in Ethereum are kind of like these autonomous agents that live on the blockchain. And the way you interact with them is you basically send transactions to them. You poke them with a transaction like, oh, hey, send some tokens over here, or I'm going to sell some of my derivatives or something. So in Ethereum, there are generally 4 categories of smart contracts. There are contracts that store and maintain data. And these are usually token contracts or what have you, store an organization's membership. There are contracts that manage relationships between different parties. And usually in the case of these public distributed blockchains, you have untrusted parties that don't necessarily want to trust that the other one acts in the honest way. There are forwarding contracts, which can implement MFN multisig, kind of. I can't remember if we went over that, but there are also library contracts. And so to give a concrete example of a minimum viable contract or minimum viable token, we made this Solidity contract which is written in Solidity, which is the high-level language that most Ethereum contracts are written in. And so you can see here, here's the Philip token, and you can create a new currency called the Philip token by giving it an initial supply, and then you can send Philip tokens to your best friend or whatever. And interestingly, you can actually put Ether into the contract, and that actually I guess that means that your Philip tokens are now backed by real money. So this just goes to show how easy it is to make a real alternative currency on Ethereum. Now, how those contracts are actually executed on each node on the blockchain is through the Ethereum virtual machine. So these contracts start off as this high-level Solidity code usually, and they get compiled down into a low-level bytecode essentially called the EVM code. And there are a few key points about the EVM code. It's designed for simplicity. It needs to be deterministic. So when you execute a contract on some input, it should always yield the same exact output. It's also supposed to be space efficient. It's specialized for Ethereum's particular use case, so it has lots of cryptographic functions, specialized opcodes for storing into Ethereum's like infinite memory, basically. So you can see here you have like a Solidity contract or a Serpent contract. These are like high-level contract languages, and they get compiled down into this like low-level kind of stack-based language. So now, one particular issue with like a naive Ethereum virtual machine implementation would be, what if you write a contract that has an infinite loop in it? What happens then? Well, in the naive case, every node on the network would execute your contract and would go in this infinite loop forever, and basically like the entire network would stop. So how do we stop that? You might think, well, maybe we could like tell somehow if there was an infinite loop, but as you can show by the halting problem, that's not possible. So instead, what Ethereum does is they basically add a fee for every instruction you execute in your contract. And this fee is called gas, which like fuels the contract, essentially. And how you execute a contract is you basically say, I'm going to start out with some amount of gas, and if it runs out of gas, then the contract like dies, basically. Otherwise, your contract runs, and you get the remaining gas that it didn't use. And so gas is converted from Ether, which is like the actual currency, into gas by using the gas price that you pass in. It's like the exchange rate from gas to Ether, Ether to gas. Yeah?
Wait, so who exactly gets charged by this gas?
Yeah, so how it works is like if I want to use a contract, use like a function in the contract, I create a transaction pointing at that contract with like some extra metadata that tells it to run some function. And so I have to pay the gas cost. And that gas cost, when the contract gets executed, goes to the miner who found the block that like mined this, that this transaction is in.
So if this contract were to activate some other contract, and who would get charged for the gas in that second contract?
Yeah, so the original sender is the one who fronts like the entire gas cost. And so basically, if when you're like recursively calling a bunch of contracts, if this like start gas amount gets exceeded, then the entire chain of like contract execution gets reverted. But keep in mind that if you run out of gas mid-execution, you don't get the gas back. It's not refunded. So in this way, we kind of de-incentivize malicious contracts or ones that would perform denial of service attacks by basically making it expensive to run a denial of service attack contract. So in theory, it's possible to run a really computationally heavy contract, but in practice, it would be very expensive. And so some things to note about Ethereum smart contracts is that, and Ethereum like network in general, is that it's not really a good idea to run like very computationally intensive smart contracts because it's expensive. And the reason why it's expensive is because it almost needs to be expensive so you can have security in this distributed trustless model. So now we're going to go into some smart contract use cases and kind of analyze maybe a more general framework for how you can build your own smart contracts.
All right. So I have up here splashed a few more buzzwords just to throw at you that you'll see throughout the rest of this presentation. But I'm going to try my best to make sure you guys come away with a framework by which you can analyze blockchain apps and see if it makes sense to use a blockchain. So some basic use cases. Philip already covered the token system, but the key thing to think about is that in Ethereum, whenever you implement one of these token systems, it's just a database. Like all these blockchain systems are just databases, and it's a database with one operation. check if Alice has enough money to send to Bob, and then if so, subtract that amount from Alice and add that amount to Bob, and that's the only operation. There's also some other cool things you can do, like take advantage of the very open nature of Bitcoin and the fact, or not Bitcoin, of Ethereum, and the fact that Ethereum, or at least you think, is never going to go away, and your contract is always going to exist on the blockchain. So that makes a good use case for a DNS system where you want it to be backed up on the Ethereum blockchain forever and never go away. So it's pretty simple. You simply map a domain name to some IP address. It's immutable, and it's really easy to implement. When me and Philip actually wrote our first blockchain app, the example they had on the Ethereum site was, oh, you can implement Namecoin, which is a DNS registry, entire cryptocurrency. You can implement Namecoin in one line of code. And like this is basically all you need. You need some register function with your name, your IP address, and then just store that into your Ethereum contract. So moving on to some more basic use cases, there's just a lot of like crowdfunding oriented and incentivization oriented ideas that you can implement directly on Ethereum. So one simple example is like what me and Philip built at TreeHacks. So we called it Ether on a Stick to kind of play to the idea that you can put a bounty on the completion of any arbitrary task. So what basically happens is all the contributors pool money into the smart contract that's going to pay to some pre-specified recipient if and only if a prerequisite threshold number of contributors vote that this recipient completed some action by some due date. So to kind of like get away from that jargon, or that confusing use case, is just to think about any kind of negative externality that you see in economics. Say you have a company that's polluting a river, and then these nearby residents are bearing the negative cost of having to deal with this pollution. The local government is slow and unresponsive, or for whatever reason they can't coordinate a cleanup. But these residents, since they have this negative utility, they're willing to pay to resolve this problem. So one way they can do this is they can pool their money together into this smart contract, and then it's basically a guarantee to this company that if the company cleans up this action, then they're going to receive their money. And at the same time, for the people contributing to this pool, if there's no risk of ever contributing to the pool and then not getting your money back without having the river also cleaned. So it's basically a risk-free way to make anyone do anything through this bounty. Yeah.
So there is risk to the company if the people don't vote Zeus.
Yeah, that is true. You could Sybil attack this. This is just like a hackathon project, but this is just an example of something you can do on Ethereum. Oh, and this implements something called a dominant assurance contract, which is basically the problem of there's a lot of free riders and there's no market incentive to create a public good. So this contract would allow for the coordination of the creation of that public good. So diving into some more advanced use cases. So this is just an example of how you can implement something like decentralized file storage. So typically we pay Dropbox, or Google Drive to some fixed amount every month to store our files. What if you could do that on the Ethereum blockchain and have it completely immutable and it'll always exist on the blockchain? So you can do this. You have your file, you split it into blocks, and then you encrypt each one of these blocks to preserve your data privacy. Then we go back to this idea, okay, put all these blocks into a Merkle tree, and then you have a Merkle root, which is a summary of all the data that you have in your file. And using the previous block header, you can have this source of randomness because it's really hard to find that nonce and that affects the hash or whatever. So what you do is you write a contract that says every n blocks or so, or every n blocks, I'm going to use this previous block header to randomly pick an index in this Merkle tree. Randomly pick one of the leaves in this Merkle tree and the first contract that can provide a Merkle proof of ownership of this leaf is going to receive some small amount of ether. So basically, like as you recall, you need the Merkle branch, you need the data that hashes and all the intermediate hashes, but this is one way that you would implement a smart contract for decentralized file storage. And to simply to recover the file is pretty simple. You just query the node that has your file, pay them a small fee, probably through some micropayment channel or state channel, and then decrypt your data, and you have this adorable little kitten. Okay, so now prediction markets. Whenever you talk about Ethereum, this is one of the use cases you're going to hear about most. And I agree that Ethereum is particularly suited for these prediction markets. So the basic idea of a prediction market is that you can draw on the wisdom of a crowd, and that's a way better forecasting tool than whatever traditional pundits or experts, because typically someone in the crowd has advanced information or some kind of information that will allow them to essentially sell that information, provide that information for a monetary award. So one of the best way to do this is to provide an example. So you can ask a market, who is going to win the 2016 US presidential election? And suppose it's just two options, Trump or Hillary. And what you do is you can buy shares of Trump or you can buy shares of Hillary. And typically these shares are out of 100. So if for example, the shares are currently trading at 50 cents for a share of Hillary, and you think she's more likely to win the election, then what you can do is you can arbitrage this difference because of this knowledge that you have by buying up these shares until it gets to like 70% or whatever you think the actual probability of Hillary winning is. And then once this market executes and the winner is decided, you will get $1 if you will get $1 for every share of Hillary that you own. So how you've made money is by acquiring these shares of Hillary that were worth 70 cents for 50 cents. So you've made that 20-cent difference. And that's just the general idea of how prediction markets work in general. A little more into the mechanics. So someone creates a prediction market on the Augur network or Gnosis network. And then on the election day, there's this entire Oracle network. And you're going to randomly query these oracles to actually vote on, okay, who was the winner of the US presidential election. And then these oracles are also incentivized to vote correctly. And there's a whole bunch of different mechanisms to make sure that this whole process goes right. But the main takeaway is that, by looking at the price, you can look at the estimated probability of some event happening in the future. And there's a lot of things you can do with this. So one of the simplest things you can do is you can buy information on some event that you want to know about. So instead of hiring, like I said, these pundits or experts, you can create a prediction market like, oh, will this Hollywood film be a flop? And then just put a bunch of money into the market. And then now the Hollywood directors and insiders who actually know what is going to happen, who know whether the film is going to be a flop, they can collect that reward. And they can collect that reward by betting on the true outcome, which will increase the probability until it's no longer profitable for them to do so, meaning it wouldn't increase their expected value or expected returns. And then now you've seen that change and you say, okay, I've acquired the information. Another thing you can do is like hedging or insurance. Fire insurance is basically betting that your house is gonna, go in a fire. So that's what you do when you pay for insurance. So you can do this on a prediction market. So you can create a prediction market, is my house gonna burn down? And then bet a bunch of money that, yes, it is going to burn down. And then an insurance company or other liquidity provider who thinks, oh, they see this market, they're like, oh, I don't think that person's house is 100% likely to to burn down. Let me like put a bunch of money betting on the other side to kind of balance out where I think it would be. And if your house actually burns down, then you receive all the liquidity that was pushed into your market because of the incentive that you provided. You can also do things like set up a security bug bounty. So you can write a market that says, will my company be hacked? And then bet really heavily against it to create a financial incentive for someone to hack your company. So then if a hacker finds some exploit in your company, they're like, oh man, like I can make a lot of money off of this. They go to your prediction market and then they bet for this company is going to be hacked. And then once the contract settles, they can earn a lot of money, and you've also incentivized someone to find that bug for you. And this is interesting because Augur actually secures their own code this way. They've created a market with $30,000 worth of Ether that says, will someone be able to steal the money in this prediction market? So it's kind of like this meta meta market, but what they do is they have this market that runs every 3 weeks, and if no one's hacked it yet, then they just restart the market and continue the process so that this bounty is always there. And another thing you can do with prediction markets is you can really just signal, and you can play to this notion of put your money where your mouth is. So say you run a Kickstarter campaign, and your investors they've seen Kickstarter. They've seen that a lot of people tend to miss their deadlines, and they tend to ship months later after they said they would. So what you can do to boost the confidence of your investors is you can say, okay, here's this prediction market. I'm going to bet really heavily that I will ship this product on time. And what you're doing by doing that is opening up yourself to financial risk if you don't meet your commitment. So you're basically saying, oh, I'm going to lose all this money if I don't ship it in time. So that will comfort your investors, like, okay, he's willing to do this. I think he will actually ship on time. So let's analyze the Augur and Gnosis a little bit. What are the benefits to having this on a decentralized network? One of the biggest benefits is that there's no restrictions on market creation. Typically on prediction markets, you can't just create whatever market you want, and you also need some kind of network of people to verify these events, but Augur and Gnosis provide the incentives to do that for you. But there are some ethical issues with that. For example, you could create an assassination market. Someone that you really don't like, you say, is this person gonna die by this date? And then you put a really, really heavy bounty like, oh, they're not going to die. So then any assassin could see the market and say, oh, if I kill this person, I can collect all this money. So both Augur and Gnosis have kind of this built-in ethical mechanism that I don't know much about, but you can read about if you're interested. Another benefit is that there's a shared liquidity pool. There's no reason why this same market should exist in multiple countries if all these different markets are betting on Trump versus Hillary. This also allows for more advanced markets and some interesting ideas such as combinatorial prediction markets, where you basically say it was still the primary season. You could bet oh, I think Trump is going to win this primary. And then using the shares that you just bought, you can use those shares to buy, shares of, I think Trump is also going to win the presidential election. So just multiple levels of markets that you can bet in simultaneously with the same amount of capital. I'll just kind of briefly cover over this. Filament, in a nutshell, they do industrial IoT, and they integrate blockchain technology into their tech stack. They build these sensors with a 10-mile range, with a battery that lasts years, and no internet connection. And I think Filament is a really good use case of blockchain because they're really taking advantage of the resilience and the dependency of blockchain. Notice that the blockchain is only a small part of their stack. They only use that for public, authenticity of their name and address bindings. And if their goal is to create some network that's always going to exist no matter what conditions, then blockchain is a good way to do it. Another interesting startup is a company called Slockit, and they create a lock that is connected to an Ethereum node. And whenever you send money to that lock, it unlocks itself. So you can imagine automating Airbnb. Instead of meeting up with the owner and they give you a key physically, instead you can just go to the house, pay some ether to the lock, and it'll let you in. That's a little interesting use case. You can also do things like, put deposits into this contract that will pay out once you actually leave the house and lock it again. You can also do things like rent out your routers on demand. Someone can pay your router and then get internet access. You can also do things like a fully automated shop with no human personnel required by storing all the items behind some lock, and you just pay the lock and receive the item. That's how you pay. Yeah.
But can't you just do that anyways without Ether or anything like this, just by checking did the person pay, and constantly checking for that event, and if they do, then unlock the thing.
Yeah, that's a very good point. The thing we have to always be careful about when talking about these decentralized apps is why is it better than a centralized database? And I'll be talking about that in the next slide. Yeah, and another thing you can do is automatic bike rentals, where you pay a bike with some deposit, rent the bike. Once you get it back, you get your deposit back. So analyzing why Slockit is decentralized. So let's think about it. Slockit, okay, in general, these distributed systems, they're trustless, which is a good thing. But in some ways, it's not. So for example, in the Airbnb case, where you actually kind of want to know the people that are coming to your house and know the identities of the people that you're renting from, and it's probably better to have some kind of central solution like Airbnb to manage your reputation and reviews and historical everything, and just kind of ensure that happens for you, and it incentivizes Airbnb to do something about it. So in this case, decentralizing probably isn't the best idea. One benefit of Slockit, though, is that there's a qualitative improvement in user experience with distributed technology. You're able to receive funds and send funds without revealing your personal information. That's a big thing, because now you can have an open financial network, and you have much easier integration with the masses and much easier time trying to get to those network effects. And then there's also this idea of device autonomy. If you really want your system to be modular, kind of like Filament is, then blockchain is probably a good idea for you. There's also something called decentralized autonomous organizations. All right. So it's essentially an organization governed by code, where all the laws are, the code is law, math is law, and there's nothing outside of it. There's no really legal jurisdiction that you have over these DAOs. So you can think of the future when supposedly everyone uses Bitcoin or Ethereum or whatever, and businesses can pay their operating expenses in Ether. Then you can have businesses that exist as DAOs and exist entirely as a blockchain and just on this cyber realm without any physical grounding to any country. So some examples of this, there's Dash, which is a privacy-centric cryptocurrency. A percentage of the mining reward is distributed to this pool where masternodes can then vote to fund different proposals using that money. There's the DAO, which you probably heard of. It was the largest crowdfunded project in history and raised over $150 million worth of Ether earlier this year. And then in June, it was hacked of over $60 million worth of Ether, and the market cap of Ethereum dropped by $1 billion. So that's the other really scary thing about these distributed systems. Because for example, if you hack a web company or something, you just have data. Now you have to monetize that data. But with Ethereum and Bitcoin and all these like trustless systems, like as soon as you hack it, like that money is yours. Like it is the most adversarial environment. So this is why security is always such a prevalent topic when we're talking about these distributed systems. Just some quick drawbacks to DAOs. It's really hard to edit the governing laws of these DAOs. One solution is to allow your DAO to split into a child DAO that has its own different code, but that was actually the vulnerability that was exploited by the attacker that hacked this, like the DAO. And then you also get a participation problem. Okay, so in the remaining of the time, I want to try to build up an intuition of, okay, what's blockchain good for? What is blockchain not good for? So there's a few key limitations that you must think about when considering like whether or not this application would be good implemented on blockchain. And one of the biggest things is that there's no trustless way to access the outside data. And you, like Augur, you need to rely on these oracles to provide these information. One solution to that is you can have proven execution of these oracles, or of the code run by these oracles. So basically, you're not trusting these oracles. Oracleize it has a really like shoddy implementation, but basically they implement something called TLS Notary, which modifies the TLS protocol to prove that you received this HTTPS page to some auditor. Another solution is like what Augur did. They have an Oracle network, and you randomly select on them to vote. But the drawback to that is you have another consensus protocol on top of a consensus protocol. So it's really hard to align the incentives that way. There's no way to enforce on-chain payments. Like you can't really do things like loans and bonds on Bitcoin or Ethereum because the money needs to be held on the blockchain in order to ensure that payment. I think this is kind of clear. If you think about the intuition that like we pay interest on loans, particularly because there is a default risk, it's not really a loan if there's no risk. And then contracts cannot manipulate confidential data. So no matter what you do with your data, like cryptography-wise, as long as it's ever assembled on the smart contract, that means some computer in the world is assembling your data on their computer, and they can possibly read that data. So the only thing you can do is just encrypt your data before you put it into the blockchain, and then decrypt it locally. But there are some like research areas in this direction. There's something called homomorphic encryption, where you don't actually know the contents of the encrypted data, but you're still able to do operations on that data, like add operations, for example, and it still maintains the integrity of the data while ensuring that you don't know anything about it. Okay, and then this slide, I crammed a bunch onto this slide because this is the most important. I actually highly recommend taking a picture of this because this is a cheat sheet of how you should think about blockchain killer apps. So I'm just gonna play through some of these concepts. You can think of these decentralized apps and distributed systems as purely client-side software. You're writing clients that will agree with each other with some set of rules defined in your software and then be able to come to agreement on some kind of state or some kind of database transaction or whatever. One thing you can apply this to is any environment where you need, where parties don't trust each other or they need to coordinate somehow without some kind of central entity. This is like you'll hear about blockchain entities like blockchain consortiums, like where the banks don't completely trust each other, but they trust like 10 out of the 15 other banks. Okay, cool. That's enough to establish a consensus on a distributed system. You can also think of these decentralized currencies as good as programmable money. It's a really good currency for machine-to-machine payments, particularly because it's an open financial network. It's also really good for fault-tolerant and resilient systems. So kind of like the filament example where you want just this ad hoc network that's always going to exist. And you can also use Ethereum and these technologies to create incentives that you could never do before. Like Gnosis or the Ether on a stick that I talked about with Philip. You can also have new governance models. There's DAOs, and there's also something called futarchy, which is a form of government based on prediction models. In a nutshell, you bet. It allows you to voice a stronger opinion using money and betting whether or not this politician is going to execute well or whatever. It's also good for any kind of censorship resistant. If you don't trust the clearinghouse or land right registry or whatever, then a blockchain is good for you. And just in general, it's trust in math and code. The key contrast with centralization, though, is that in a centralized app like Google or Facebook, they have all your data. So this means they're able to do machine learning on all that data and optimize your personal user experience. With distributed systems, when all the data is at the ends, you can't really do that. But what you get from that is you get your privacy back again. So there's trade-offs. So really, you always want to ask, why is using a blockchain better than a central database? And all the things on this slide are basic guidelines of, okay, this is probably a direction you should explore if you're thinking about writing your app on the blockchain. Okay, so, that was a lot. All right, next time we're going to be talking about community regulation and controversy. Homework for tonight is going to be a half-page paper on your own smart contract or dApp idea. We'll email that out in an hour or so. There's some readings. They're pretty quick. It's just Wikipedia articles or CoinDesk articles. And then this Saturday, there's a pretty awesome event. Vitalik Buterin, founder of Ethereum. We have co-founder of Coinbase, UC Berkeley professor Alessandro Chiesa, and a few other founders and CEOs or whatever. They're all coming down to Foster City for a half-day-long speaker event. So that's probably the biggest names I've ever heard of here in the Bay, just all at one event. We also have our info session for our new consultancy. So we're recruiting developers and consultants. There's going to be free pizza next Monday at 7 p.m. You can find all this information on the Bitcoin Association of Berkeley group. And then we're also going to a talk as a club. Yeah, I think that's it. All right. Thank you guys for coming. See you next week.